Why is the Federal Reserve removing money from our financial system while debt continues to pile up at record rates? On today's episode of the TFTC podcast, Parker Lewis, head of business development at Unchained, breaks down why our monetary system is more leveraged than ever before. In today's discussion, we'll examine three central points: how the Fed's policy of reducing base money while debt expands is creating dangerous systemic leverage, why the current $101.5 trillion debt to $7 trillion base money ratio is unsustainable, and how Bitcoin has historically performed during previous liquidity crises. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. The final clip reveals a crucial insight about Bitcoin's role in the coming crisis that might surprise you. But first, let's understand how we got here, as Parker explains the Fed's dangerous game of musical chairs with our monetary system.
About, say, in the end of 2007, there was about $53 trillion of dollar-denominated debt in the U.S. system-wide. That's pre-crisis, and at that point, there was only $900 billion in all of existence. That's base money. So approximately 50 to 1, but of that 900 billion, only 350 to 400 billion was actually in the banks, and the banks are the source of leverage, and I think of that money as what's available to the banking system. So they've taken out $2 trillion from the system from 2022 to today. At that same time where the U.S. system stands in total, the reason why they have to put the money in is to quell the liquidity crisis, which is a credit crisis. Whereas they take the dollars out, there become fewer dollars relative to the same amount of debt, and then everyone figures it out and they start heading for the exits. It's essentially re-leveraging the system.
Parker is explaining how the Federal Reserve has been playing an increasingly dangerous game with our monetary system, one that's creating the perfect conditions for a financial crisis. Think of it like this. In 2007, for every one real dollar that existed, there were about $50 of debt in the system. That's already a staggering ratio when you think about it. But what's happened since then is even more concerning. The Fed has been actively pulling dollars out of the system while debt keeps growing exponentially. When they do this, it creates more pressure on the remaining dollars, kind of like musical chairs. There are fewer and fewer chairs, dollars, while more and more people, debt, need somewhere to sit. When Parker talks about base money, he's referring to actual dollars that exist in the system, not credit or promises to pay, but real dollars. The fact that they're removing these real dollars while debt continues to pile up is creating an increasingly unstable situation. This dynamic is precisely why Bitcoin becomes more attractive. It can't be manipulated this way. Its supply is fixed and transparent, unlike the dollar system where the Fed can add or remove dollars at will, creating these dangerous leverage cycles that Parker is describing. What's particularly concerning is that this pattern of removing dollars while debt grows is exactly what led to previous financial crises. The Fed seems to be setting us up for another one, and it could be even bigger this time given the scale of the numbers involved. Through my work at 1031, I've seen how businesses are increasingly preparing for this scenario by building Bitcoin infrastructure as a hedge against this systemic risk. We've just seen how the Fed's policies are creating dangerous systemic leverage, but what's even more shocking is the actual numbers involved in this debt-to-dollar imbalance. And stick around until the end, because Parker's insights about Bitcoin's role in the coming crisis might surprise you.
So that's system-wide, federal, state, local, corporate debt, financial, non-financial, consumer debt, auto loans, mortgages, student loans, credit card debt, all of that is 101.5 trillion. So when you think about that in context of pre-financial crisis, we started with this credit problem, this credit crisis, too much debt, not enough dollars, of 52 trillion. Now that system is nearly doubled in size, and it doubles. It is induced by the creation of money. So 101.5 trillion of debt stacked against 7 trillion actual dollars as base money. And functionally what happens is the Fed goes from 9 trillion to 7 trillion. The amount of debt doesn't go away. The debt's continuing to expand. The federal government's running $2 trillion deficits plus. That as they take the base money out, that 9 trillion going to 7 trillion, there's fewer dollars that are being competed for, not just by the debt that exists, but everyone in the economy.
The numbers Parker just laid out are staggering and provide clear evidence of why our current financial system is becoming increasingly unstable. We've gone from a system with 52 trillion in debt to one with 101.5 trillion. It's nearly doubled. But here's the really crucial part. All of that debt is competing for just 7 trillion in base money. That's roughly a 14-to-1 ratio, and it's getting worse as the Fed continues to pull money out of the system while government deficits add more debt. When Parker talks about competing for dollars, he's describing a very real dynamic where there literally aren't enough actual dollars to go around compared to all the claims on dollars that exist through debt. This creates a serious problem because eventually someone's not going to get paid. It's like having 14 people all holding claims to the same dollar. Mathematically, it just doesn't work. This extreme imbalance makes Bitcoin's fixed supply and transparent monetary policy increasingly attractive as a hedge against this systemic risk.
Sup, freaks? This rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20.
The scariest part about all of this is that we know from history that when these leverage imbalances get too extreme, something eventually breaks. What makes this time different is the sheer scale of the numbers involved. We're talking about the largest debt bubble in human history, and it's still growing. This is precisely why more people are starting to question the long-term viability of the current financial system and looking for alternatives that can't be manipulated this way. We've now seen the dangerous leverage in the system and the extreme imbalance between debt and base money, but what you're about to hear next completely changes how we should think about Bitcoin's role in the coming crisis, and it's not what most people expect.
So I think in that world, like Bitcoin can't be the flight to safety because it's one, definitionally under-owned, and then it being under-owned is the best signal for not understood.
Yeah.
It's that 2 trillion of base money that 2 years ago was available and sloshing around, and it's impossible to know what that tipping point is, right? It was impossible to know in 2019 what the tipping point would be for the repo market, but then it shows up overnight and everything changes. What's impossible to predict is when and where. What's possible to predict is the inevitability of there being a liquidity crisis if you are taking dollars out of the system and putting them into a black hole while this metastasized credit system remains there and ever growing.
Yeah.
Certain, it's not an if, it's a certainty.
Yeah.
It's just it's a mathematical dilemma, and that I was when I say that it's difficult to predict when or where, I mean that, you know, in the 2008 financial crisis, first it was subprime, but then it expanded out. It was commercial paper, it was everything, you know, kind of it snowballed and became a waterfall effect.
Parker makes a fascinating point here that completely reframes how we should think about Bitcoin's role in a financial crisis. While many people assume Bitcoin should act as an immediate safe haven asset during market stress, Parker explains why that's not realistic yet, and his insight reveals something crucial about where we are in Bitcoin's adoption cycle and how it performs during crises. The key revelation is that Bitcoin can't function as a traditional flight to safety asset right now because not enough people own it or understand it yet. Think about what happens in a crisis. People move their money to assets they already own and understand. They don't typically learn about and buy into entirely new assets during moments of panic. When Parker says Bitcoin is definitionally under-owned, he's highlighting that we're still in the early stages where most people and institutions haven't even begun to accumulate it. This actually strengthens the thesis that a liquidity crisis will accelerate Bitcoin adoption because each crisis has historically led to more people understanding and adopting Bitcoin after witnessing how it performs. What's particularly insightful is his point about the unpredictability of when exactly a crisis hits. While we can see the mathematical certainty of a problem, too much debt chasing too few dollars, it's impossible to predict exactly when and where the system will break. We saw this in 2019 with the repo market crisis, in 2020 with the COVID crash, and in 2023 with regional banks. Each time the breaking point came as a surprise, even though the underlying conditions made some kind of crisis inevitable. This creates a powerful pattern for Bitcoin that Parker has observed through multiple cycles. While it might not be the immediate safe haven during the initial shock of a crisis, it has historically performed exceptionally well in the aftermath, when the Fed inevitably prints money to stabilize the system. Looking at the previous 2 clips, we can now understand why the extreme debt-to-dollar imbalance forces the Fed to print money, and Bitcoin's fixed supply makes it the perfect asset to hold during these money-printing episodes. Parker's warning is essentially that we could see another one of these cycles, A sharp sell-off across all assets, including Bitcoin, when the crisis first hits, followed by Bitcoin dramatically outperforming everything else once the money printing begins. This pattern has played out multiple times now, and understanding it helps explain why Bitcoin, despite its volatility, continues to gain credibility as a long-term store of value, even if it's not yet ready to be a short-term safe haven. Will a liquidity crisis actually make Bitcoin more valuable? Let me know in the comments. I read every single one. And if you found this analysis of the Fed's monetary policy interesting, you'll want to watch our breakdown of how America's Bitcoin leadership is reshaping global finance. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.